I want to set something straight. I was recently asked by some people about trading and why don't we trade? Why don't we buy and sell stocks and those sort of things? And I thought I was clear enough in this podcast series and in all our documentation that we have in Orange Capital Partners, but it seems to just not come across. So I want to dedicate this episode just to clarify what it is we're actually doing, why trading is almost a completely negligible thing of the operations of Orange Capital Partners, and in my view also of any kind of wealth generator. And I think it's also in light of the drawdown we just had, because the question came up, well, what are you doing now? Why are you trading and all that? And I just want to clarify that and also give some shed some light also on the strategy and the philosophy of the fund and the principles that we build our operations on. This is the Not Even Wrong podcast, September 21st, 2001. This is Krim Delco. Since the last update, the fund is down 5.9%. The market's down 1.7%. For the year, we are up 8.5%. The market's down 16.8%. We're underperforming by 8.3%. So massive drawdown yesterday. This is as I said in the episode yesterday, it was before the market opened, the Evergrande saga in China is drawing down stocks, and I want to discuss that a little bit, and then go right into this explanation of our trading philosophy, of basically what we're doing and why we're not trading around stocks and things like that. So first and foremost, what's going on? China Evergrande is a real estate company. They've been in trouble for more than a year, and over the last couple of days, basically, the market has sniffed or understood or fears or is already certain. I don't know exactly what it is, but certainly the fear that this company now will start defaulting on their debt has spread through the market. That creates a lot of tension in the debt market, and because the debt market is very intertwined, there's usually a lot of leverage, and everybody always expects to be paid. When somebody doesn't get paid, then there's counterparty risk, there is liquidation, there is a dash for cash, and this is what we saw yesterday in China, and then also here in the US. We had a massive fall down in the 10-year yield in the US. So the treasuries, basically money went into treasuries. So we had all these typical reactions of kind of panic selling. We had also crypto was down, and growth stocks, Tesla, our biotech stocks, which certainly have very little to do, the biotech stocks in particular, with the Chinese macroeconomy, but this is, like I said, trading related. So this is what happened. And I said yesterday in the episode that actually for us this is a good thing, because finally we know what's going on in China. Finally we know why the sales have been so sluggish in China. And this is a little bit on us. We should have known this before. We have not been aware of the China Evergrande saga. We have not been aware of the risks that are involved with China Evergrande. And this just has sort of shed light on the situation. So it took kind of the markets to turmoil for us to notice. And this is a bad on us. This is our bad, because as a hedge fund, we are supposed to be in tune with these things. And our largest position is Tesla, and Tesla had some sluggish sales performance in China. So we should understand that the real estate market in China is in trouble, that there are some issues and all those sort of things. So we didn't, so this is a bad on us. But nevertheless, now we know, and this is good. So we're pretty happy with the situation. And of course, we don't like the drawdown, but the point is not the drawdown. This is a daily drawdown. And in a fund like ours, we have our CAGR, our annualized average return over the last 12 years has been over 20%. And like I said yesterday in the episode, volatility is part of the business. Volatility is, in fact, is the business. And that's partly why we have a job, because we have to navigate these types of situations. And it's not for everybody to do that. That's why we manage other people's money. It's not because we are smarter in finding investments. In fact, a lot of people are very good at finding investments. It is the holding on to them and the sizing it up to the proper sizes, and also understanding leverage. Those are the kinds of things that are a little bit more difficult to do, and I think we have an expertise in that. So let me talk now about the trading situation. So what is it we do? We trade, we don't trade. What's the point? For us, trading is at best a footnote. It is, of course, necessary when we buy shares and sell shares, or commodities or currencies or crypto or whatever we buy or sell. Of course, we have to trade. There's a certain skill involved with trading. There's also a certain skill involved in execution and all those things. I don't want to diminish them, particularly the larger a fund gets, the more those things actually start playing a role. And even if your stated goal, like in our case, our stated goal of return is 15% unlevered after fees, which is relatively high. So even if that is your stated goal, you could say, well, I mean, look, I don't care if I lose a few basis points in trading or execution. I don't think that's excusable. I think as a fiduciary of somebody else's money, even your own money for that matter, but particularly when you manage other people's money, you have to make sure you get the best execution and your trading is done at the best possible time. So for example, you don't trade on very low liquidity days, or all kinds of market intelligence that you can get, I think is useful. There's absolutely no excuse for saying, well, I don't care, I'll just trade you know, my large position on a Thanksgiving day when the market's only open 3 hours or something like that. You have to understand market intelligence. Having said that, though, I think people obsess about it a little bit too much, in the sense that market intelligence, when it comes to things like volume and those sort of things, it's important, but that cannot be your business. That is not what we do. That is not our edge. That is not our raison d'être, if you want. That's certainly not the case, for sure. And if anybody tells you, that calls themselves a hedge fund, not an algorithmic trading hedge fund, but a regular, let's say, fundamental hedge fund, and they spend more than a couple of sentences talking about their trading execution practice, you should already be concerned. Because no matter what, if you have the best traders on Wall Street, you will only save a few basis points here and there by having better execution. The real returns are made, like I said many times, by having a proper principal stack, investing the right sizes in the right stocks, and then holding on to them as long as you can. This is always the best way to generate wealth, at least in this period of time that we are now. We believe that for the next decade or so, for sure, we will be in this kind of realm of the financial markets, because there is enormous wealth generation coming towards us. We have artificial intelligence, in particular self-supervised reinforcement learning, which we believe is the next big breakthrough in artificial intelligence, combined with modeling the world through animation, so making animation better, so self-learning can be improved. And then we have the CRISPR tech revolution, and the digitization of life sciences, and then we have the blockchain technology. So those three big technologies, in our view, are going to generate enormous amounts of wealth, and hopefully we can participate in this wealth generation in an intelligent way, and therefore we should be fine, and we don't have to, we are not in the business of buying and selling shares, trying to time the market and all that stuff. Having said that, I believe, and this is just my belief, I can't prove it, I don't think that there is a way to time the market. I think timing the market is a bit like driving a car and being exposed to complete chaos. So sometimes you see the road, sometimes you see a wall, sometimes you see a train coming at you, sometimes you see pedestrians. You can't drive a car like that. What we do at Orange Capital Partners is we try not to drive the car, we try to fly a plane. And for that, we give up sometimes returns. We don't turn right or left or this or that. We try to go from A to B in a very different way, in a very, in our view, much safer way. And it's not because trading is a bad thing or it's beneath us. It's just not possible. There is not enough intelligence. Maybe, and this is one of the pet projects that I have, this is really just an intellectual, a little bit of an exercise. Maybe through self-play, we can actually teach an algorithm how to trade in the markets. That that is a possibility that I'm playing around with. This has nothing to do with algorithmic trading. This is not trying to do statistical inference on past data. This is trying to understand the behavior of financial markets through self-play, a little bit like AlphaGo Zero understood the behavior of playing Go in a very different way, in a way that is not human. This is the key. Self-supervised reinforcement learning is not based on human understanding or human learning or human explicit knowledge. It is the intelligence learning through self-play in a very different way. This is a vision, or maybe a dream, or something along those lines. I don't know if it's possible, but maybe that's a possibility, and we can talk about this. This is a pet project, as I said. Back to reality, back to today. There is absolutely no way to time the market as far as we're concerned, at least not, again, in a way that, unless you want to take liquidity risk or you want to take, well, it's mainly liquidity risk, or you have inside information or something like that. So when the markets are down yesterday, they are down. There's no way to tell if this is it, if they're going to keep going down or not. There's no way to tell when they're going to turn. But what we can say with very, very high certainty is that if, let's say, CRISPR technology keeps delivering good results in the clinic, if the advancements in CRISPR technology and base editing and prime editing even get just percentage of what they promise, if the potential can be met, then we will have such massive wealth generation that these little market gyrations that we're dealing with right now will be just footnotes. Some people might say, yeah, but what do you do if there's a catastrophe like World War III or something like that? Well, yeah, of course. I mean, we are working under the premise at Orange Capital Partners that the world as we know it, more or less, will stay the same. So we're not expecting wars, natural disasters, none of that stuff. We are expecting one big change, and that is we expect that we will have a gradual replacement of the monetary system from dollar to crypto, and that will create enormous turmoil, and this is something we have to think about a little bit deeper. But other than that, we are under the impression that the Western democracies will more or less stay the way they are, that China will more or less gear towards this centrally planned capitalist system, that we will have India staying more or less the same where it is, which means growth and some gradual opening up of the economy, and of course the liberal democracy that has been happening there has been happening, but we don't expect, let's say, a civil war or anything like that. So under these premises, we are very certain that if the technologies pan out, if people can actually solve some of the big technical problems and build innovation stacks around those technologies that we're investing in, that we will generate wealth. That we can say for very high certainty. Now, having said that, I just want to bring this point a little bit further out. We do expect a massive change within the governance structure on Earth. So we think that we are going from a human-centric, nation-state-centric, democratic, Western-type society towards a decentralized decision-making society, a much freer society, a much more market-driven society. So this change we do expect, and we don't have unfortunately, we don't have a formulated macro strategy of how to actually position ourselves most effectively for that change. We bought some crypto for that. That's one. We also believe, but this is just a belief right now, that disruption and technological innovation will survive in this type of shift. But I just want to make sure that we're not completely oblivious about global developments. We are clear about the deterioration of government institutions, and that's why we believe that blockchain-driven, decentralized decision-making will actually take over. So I just want to make that clear. But now back to this episode, and I just want to sort of plug one of my next episodes will be about this. This is a very important point. So the shift from human-centric decision-making to decentralized decision-making and absolutely more freedom will be a very big shift, and it will cause backlash from the elites because they won't like this. So that is a risk we have to be conscious about. But barring that big risk, if we stay in the system that we are, in the steady state system politically and socially and economically, if our currencies don't collapse relative to crypto in a way that it just creates panic and all that, then we think that with these disruptive technologies that we have, that our mission to generate wealth by investing in fundamental new concepts and engineering practices where large impact can be executed, and that daily trading around volatility events like yesterday, for example, are not part of our strategy. In fact, it would be detrimental if we did it, and that this type of volatility is part of life, that we have to not just tolerate it, but accept it as part of life. Volatility is, if you have disruptive change, if you have sort of an anti-fragile, to use Nassim Taleb's word, an anti-fragile system that is sustaining itself on its own sort of error-correcting mechanisms, you will have volatility. So it's fine. And that the long game, the game that we care about is the one where the technologies that we invest in gets instantiated into products and services and actually have real impact in economic terms and generate wealth. This is what we care about. This is a long-term game. Thank you.